that process was difficult for him. My youngest son is walking now, but when he was learning to walk, it was very, very difficult. Okay, so understand why I was dismissive. Hopefully, Joe, I wasn't trying to be insulting. You've just got to understand why you're doing things. Why are you going down to the 5 minute, and what is your plan to use the 5 minute in order to make more money? That's the key. Don't just put something on your chart or do something on the chart without fully understanding why you're doing it. Now, since I was dismissive on the first part of the question, I appreciate you emailing me back. And I will acknowledge that it would have been more prudent for me to answer your other question. Joe asked, is it more accurate to anchor fib retracements to larger moves that happen over longer time frames? Reading into that is the age-old question of what Fibonacci is more effective. Is it more effective to anchor a Fibonacci like this? Should I come down to this? Should I go up to a 240 minute? Should I go all the way back here to this high and this low? Okay. There's no easy answer for that either. My basic philosophy is with Fibonacci is I use it as a guide. Okay, I'm not going to trigger a trade simply based on a Fibonacci level. But let me give you an example. I will look at both of these. Okay, I don't think there's anything wrong with that. I'll take one Fibonacci from here. I'll take another Fibonacci from there. Make sure that they're lined up. And then I'll see, all right, there's a bit of overlap right here. There's a bit of overlap right there. So while I might look for a reversal in this area because it's the 618, I'm not going to just enter the market short here at the 618, even though it is a double top. I'm going to look for a compression pattern. I want to see that the professional money is in there moving the market around. Okay? Nor do I think that this Fibonacci is any better than this one. I think that that they may both have some reaction on the market. Okay? I will say this, that when you go down to a 5 minute bar, the problem is you just can't see a lot of information at all. Even when I zoom all the way out, I can only get back to the 20th. Okay? So if I'm trying to draw Fibonacci retracements, the only thing I can do is look at a small time frame. Okay? And what I liken this to are dropping a pebble into a pool of water. Okay? If you've got this really small pebble that's coming down, it drops into the pool of water, what you're going to see are these little ripples. Okay? In both directions from when the rock hits. Okay, these little ripples. On the other hand, if you drop this huge boulder into the water, you're going to see huge ripples as the boulder hits the water. Okay? I talked about this, I think, in the Fibonacci section. So I look at a 5 minute bar like pebbles. Because think about it, how far can the pound move in just a short period of time? Now, on the average day, true enough, you're looking on average at 140 pips. But if you look at the 5 minute and you're cutting this 140 pips, basically what you're doing is you've got all these little divisions. Okay, if you're chopping this 140 pips up in 5 minute increments, no one 5 minutes can really be that big. So I think that there is a danger in that, only that it gets you so focused on the short term that you miss the bigger picture. Okay, that's why I don't go down to the 5 minute. That's why I don't think there's really much use in the lower time frames. Maybe, well, no, I just don't do it. Some traders do. One of my trading mentors uses 5 minute time frames quite a bit. I think with the 15 minute bar, you're going to see the same information as far as price. In other words, if I bring this 5 minute bar over here